If you're waiting for the perfect time to invest, you might be accidentally choosing the worst plan, doing nothing. Because the truth is, wealth isn't built by genius picks. It's built by a boring system you can repeat. Today I'm giving you a simple investing plan that works whether you have 50 euros or 5,000 euros a month, and it doesn't require charts, crypto calls, or checking your portfolio 10 times a day. I'm going to show you the one mistake most people make when they start investing, the 3-bucket system that makes investing almost automatic, and exactly how to set it up in under an hour. By the end, you'll have a plan you can actually follow, even if you start late, even if markets are messy. Most people don't fail because they're lazy. They fail because their plan depends on motivation. They invest when they feel confident and panic when they don't. Here's what that looks like. Markets go up, they buy. Late markets go down, they freeze or sell. Then they repeat the cycle and call investing risky. So the goal isn't to predict the market. The goal is to stop your emotions from being in charge of the plan. Most beginners ask, what should I invest in? But the real question is, how do I stay invested no matter what? Because if you don't have a cash system, you'll always end up doing one of these. Investing money you'll need soon, selling at the worst time, or stopping contributions when life gets expensive. So before we talk investments, we build the foundation, cash stability. This is money for surprises, car repairs, rent increases, a job gap, medical bills. Rule: keep it boring and liquid. Typical range: 3 to 6 months of essential expenses. Why it matters: an emergency fund prevents you from selling investments when life happens. Anything you plan to use in the next few years does not belong in the stock market, because the market can be down when you need the money most. This bucket is 4. House down payment, moving costs, education, big purchases, starting a business. Rule: keep it low risk and appropriate for short time frames. This is where investing gets powerful. Money you won't touch for a decade or more can ride out volatility and capture growth. Rule: simple, diversified, low cost. This is where many people overcomplicate things. They chase hot stocks, sector bets, timing strategies. But for most people, the boring approach wins. Broad index investing plus consistent contributions. Let's keep it simple. Here are 3 portfolio levels depending on how hands-on you want to be. Option A: 1 fund portfolio, a global diversified fund that covers many markets. Goal: maximum simplicity, minimum tinkering. Option B: 2 fund portfolio, 1 fund for global equities, 1 fund for high-quality bonds. Option C: 3 fund portfolio, total/global stocks, international stocks, bonds. Key idea: you're not trying to beat the market. You're trying to own the market and let time do the heavy lifting. Now the part that actually builds wealth: automation. Here's the rule: pay yourself first, automatically, on payday, even if it's small. Because investing isn't a one-time decision. It's a habit. And when markets drop, automation becomes your superpower. You're buying when prices are cheaper, without needing courage. If you feel behind, here's the truth: starting late is still infinitely better than not starting at all. You don't need perfect timing. You need a stable cash base, a diversified long-term portfolio, and consistency. The market rewards time in the market, not intelligence about the market. Here's your 1-hour setup. Calculate 1 month of essential expenses, build emergency fund targets, separate near-term goals from long-term investing, choose a simple diversified portfolio approach, set an automatic contribution on payday, stop checking daily. Check quarterly. Do this, and you'll be ahead of most investors. Do this, and you'll be ahead of most investors.